Hello and welcome to Askimo TV. Today we're sitting with Michael Friedman, the Executive Director of Asquith Merchant Bank. We're talking about merchant banking and we're going to talk about turning a profit, which is something that every company and every investor would like to see happen. So Michael, perhaps you can give us a little introduction to the idea of how would a company start to try to turn a profit?
Well, the answer to turning a profit is fairly simple. Whatever it is that you have to buy to make your company work, you need to sell it for more money than that, and you need to make sure that the difference between the two is larger than the amount that it costs you to run your business. And that's really the basics of turning a profit. So from there, obviously, you start to get into a much more complex place. So it's about really what your business is and how it works as to how exactly you turn a profit from there.
So, as I understand it, the first step would be to generate revenue and then make sure that your costs are low enough so that the revenue starts to turn into a profit. So if I'm a company, and obviously all companies are different, what are the steps that I should try to take to ensure that I'm generating a revenue in the first instance?
Well, I think the key with that is having a product or a service that you're intending to deliver that you know people want. So I would say that anybody who's looking to start a business, the first thing that they should do rather than register a company and start trying to deliver it is to go through an iterative process where they learn the market and they try and test as much of their product or service as they can in ways that are not too expensive for them to do. And I think that probably gives you the best chance to then turn a profit when you eventually do go through the formal process of launching a business. And also what one realizes is that whatever you think your costs are today and whatever you think your operating timescales are today, when you actually start doing it, it often looks very, very different. So as much as you can do to try and understand your operating environment to really quite a nuanced level before you start really expending capital, and also I think this is another matter of before you start raising capital from other people and putting yourself under pressure to pay them back, one should do as much as one can on your own, and that's something called bootstrapping. Bootstrapping basically means that you take your resources and any friends and family or partners who wish to be involved with you, and you take their resources and you start with that first, and you build up as quickly as you can within that environment before you start to really employ outside capital and start to put in serious man hours and take really big risks.
Thinking of merchant banking, where you've mentioned that the life cycle can be not a matter of months, but a matter of years. What sort of things are you looking at when you're trying to determine whether a company is likely to become profitable in the future?
Well, merchant banking is usually a phase of investment which is a little further down the line than startup. So generally, we're already seeing companies that have revenue. Most often, they're already turning some profit. And what we're investing in is the scalability that allows them to increase that profit margin. And that's generally the point at which we're entering into an investment. So we're looking at a slightly different set of criteria than perhaps the venture capitalists would, where they're just looking at an idea on a piece of paper, perhaps very little market testing, and saying, well, we think this is brilliant and we're willing to take a chance on it. We're much less interested in the risk of doing that. We're much more interested in making a gentle return over a reasonable period of time. And part of that is also the nature of the companies that we invest in. So we very rarely get involved in, for example, an app for an iPhone, because who knows where the app market or the iPhone market will be in 5 years' time. So it's very unlikely, just by the nature of what it is, to be something that's interesting to us as a long-term investment. Equally, buying a piece of real estate is not interesting to us because it's boring and it's not a dynamic product, and it's something that probably requires longer than the 5-year horizon before you're going to start to see any really major and meaningful return out of it. So we're looking for things in the middle that have that balance of being nimble products that are interesting, that have growth potential, without them being really, really high risk.
Okay, thank you very much, Michael, for taking the time.